President-elect Trump is promising more tariffs. In a post on Truth Social, Trump laid out plans to impose sweeping new tariffs on Mexico, Canada, and China as soon as he takes office, following up on one of his core campaign promises. Joining us now, we want to bring in Joseph LaVorgna. He's the chief economist at SMBC Nikko Securities America and former chief economist at the National Economic Council under President Trump. It's great to have you here, Joe. Thank you so much for taking the time. I guess Wall Street is trying to wrap their heads around what exactly this means in terms of the implications economically, the implications here for the markets. I'm curious just to get your assessment of what this would mean.
The tariffs, I've argued, and this is consistent with President-elect Trump's economic agenda, which is an integrated approach whereby you have tariffs that occur alongside low corporate tax rates, low regulations, a cutback in government spending, and abundant energy output. And essentially all those things work together to slow the offshoring, to get more onshoring, more reindustrialization in the U.S. economy, and essentially build a much stronger base. And tariffs are a key tool in using that agenda.
Joe, do you see it as more of a threat, or maybe not threat, a negotiating tactic, or do you see this potentially really reshaping global trade as we know it?
As Secretary-designate Besson has said, it's escalate to de-escalate. So there's certainly a transactional component to it, no question. But it will depend in part on a case-by-case basis. And as President Trump highlighted last night, there are certain countries that certainly are going to be caught more in the crosshairs, where there certainly needs to be more reciprocal trade and more even fair trade. And certainly China fits that mold. So it will depend. I think the markets generally have things right. They're very excited about President Trump's policies. And we saw in the first Trump term that inflation was actually very low. And what's amazing, if we actually look at import prices from China, they fell. They fell from when President Trump was in office in January 17, really through the pandemic. It wasn't until the economy started really accelerating in the back half of 2020 that import prices from China went up. So the U.S. didn't even bear the cost of those tariffs. It was predominantly China.
And so which industries do you anticipate might need to be making the most preemptive or proactive, taking those measures in even not knowing how this is going to kind of play out in the negotiation process once we finally do get there?
I can't speak to what industries, the overall benefit will be to the U.S. economy in totality, to try to really engineer much stronger manufacturing output to get worker wages higher. Certain sectors will be impacted more than others. Certainly the energy sector is very important to getting President Trump's agenda through in terms of keeping inflation low. And energy is such an important cost in the production process, in the industrial process, that you need to have those energy costs low. And certainly you're seeing the energy sector respond positively. But beyond that, it's too soon to say who benefits, who doesn't. We'll see how the tariffs come in. But again, it's a key tool in getting the next administration's agenda done.
Joe, how should investors be thinking about the inflationary risk? We hear arguments from both sides. Some analysts are coming out, and economists are coming out saying that it's going to be almost a reflation trade sort of scenario. You have others, on the other hand, saying it's actually not going to have that substantial of an impact. What do you think?
Yeah, well, again, if you use the first example where there was over $300 billion in tariffs applied to China, almost $400 billion, import prices in China came down. China absorbed pretty much the entire effect. But the other point, as I mentioned with respect to energy is about 13% of the economy. The total share of imports is about 11%. So if energy costs move lower, that would offset any rise in tariffs, assuming there even was import prices coming from tariffs. That energy reduction could offset all, if not more, of any of that increase. So again, it has to be. I don't like when people just look at the tariffs in isolation. It's part of a total comprehensive process where everything is integrated, where companies want to come to the U.S. because it's low corporate tax rates, low regulation, cheap energy, things that are just favorable to producing. And I think that's the point. And tariffs are the key tool to getting our trading partners to the table, and also incentivizing companies from not leaving, and of course foreign producers who would be tariffed effectively to come to the U.S.
Do you think that there's an impact to the Fed's policy decision if we do see tariffs come forward in the way that they are being proposed, both on Truth Social and via the campaign trail?
That is my biggest risk. I wrote a piece last week on Trumponomics about how I thought the Fed is really the big risk, because the way they unfortunately model the inflation process, it's generally wage pull or demand push, meaning if the economy is growing too fast, the labor market's too tight, the Fed treats that as inflationary, which I fundamentally don't agree with. The Phillips curve, as it's known, is an unstable relationship. And therefore, I'm fearful that the Fed may look at these tariffs potentially as being inflationary when they're not. A tariff is a tax that is a price level adjustment. It's not inflation. What will happen is if energy prices come down, then the inflation rate will drop because there are second and third order effects that occur from lower energy costs. But my fear is the Fed will misdiagnose what the tariffs are designed to do and not raise rates next year, but potentially stop cutting rates when in reality they should.
They should stop cutting rates now?
I don't think the Fed should stop cutting rates now. I'm saying next year, when the Trump economic agenda is passed, I'm worried the Fed may stop, take a wait-and-see attitude, fearful of inflation that doesn't manifest itself.
Okay, that makes a lot of sense. Thanks so much for clarifying that, Joe. Joe, real quick, I'm curious just to get your assessment of the labor market right now. We've had some signs of weakening here, but overall, when you take a look at the numbers, it still looks pretty steady. It still looks relatively resilient. Are you at all worried about some of the weakness that we are starting to see there within jobs?
That's why, yes, and that's why I believe the Fed should cut rates generally. I don't know if they're going to cut in December. Maybe it makes sense to take a pause, but interest rates certainly need to come down. In fact, if you look at the payroll data, take the 3-month moving average, because we have a lot of monthly volatility. But if you take the 3-month moving average of private jobs going into September before the weather impacted the data in October, we're only 109,000 private jobs. And then if you take away the healthcare sector, which is basically quasi-government, you're only looking at like 50,000 jobs basically on average per month the last 3 months. That's a pretty soft rate. So we've got a lot of downward momentum in the labor market, and that's something that if I'm at the Fed, I'd be mindful of and be a bit concerned about.